Okay, good morning, class. Can we confirm that you can hear me before I proceed?
Morning, sir.
Okay, good morning.
Good morning, sir. We can hear you.
Okay, good. So today we are going to be moving to statement of cash flows. We will do both simple statement of cash flows and also consolidated statement of cash flows. So how do we approach this? How do we deal with this? The standard that deals with the statement of cash flows is IS 7 on statement of cash flows. And you see, you need to understand that statement of cash flows is also known as statement of changes in financial position. And you're going to understand this very soon. You're going to understand this very soon because when you want to capture cash flows, we would usually look at movement in assets, movement in liabilities and equity. That movement represents cash flows. That's why they call it statement of changes in financial position. Now, to really help you, you see, when you want to prepare a statement of cash flows, you would need the following statements. Number one is 1 year statement of profit or loss and other comprehensive income. At least when I say 1 year, I mean the current year statement. You will also need 2 years statement of financial position. That is, they will give you the current year and the previous year statement. And for consolidated statement of cash flows, you might also need 1 year statement of changes in equity at times. These three are what we use to prepare statement of cash flows. Additionally, when you have statement of cash flows, your statement of cash flows is separated into 3 sections. We have the operating activities section. We have the investing activities section. And we have financing activities section. Items in the operating activities are derived from the statement of profit or loss and other comprehensive income. Items in the investing activities are derived from the asset portion of the statement of financial position. And items that goes to financing activities are derived from the equity and liabilities section or portion of the statement of financial position. There is no way you want to have a balanced statement of cash flows if you don't touch all the items in the statement of profit or loss and in the statement of financial position. Additionally, the summation of all the balances in the three activities above must be added to the opening cash and cash equivalents and the total must agree with the closing cash and cash equivalents in the statement of financial position. You will see that after we have prepared all the items in these activities, we will then do a kind of reconciliation to check that we have captured all the items. So we will do a summation of all the balances in the operating activities, investing activities, and financing activities. So the summation of all those balances will be added to the opening cash and cash equivalent, and the total of that two must agree with the closing cash and cash equivalent in the statement of financial position. If they don't agree, then something is wrong with our computations and our presentation. I mentioned cash and cash equivalent. So these are a means of exchange in any country that are generally acceptable and have an insignificant risk of changes in value. And examples are your cash at hand, cash at bank, and highly short-term investments. Highly short-term investments whose maturity is not more than 90 days. Not more than 90 days. That's cash and cash equivalent. An example of such short-term investments are, you could have your fixed deposits, you could have investments in treasury bills, you could have investments in commercial papers, and even your bank overdrafts. These are cash equivalent. Furthermore, there are two methods for preparing statement of cash flows. We have the direct method, we have the indirect method. The difference in these methods lies in the presentation of the operating activities section of the statement of cash flows. The investing and financing activities section are presented in a similar manner, irrespective of the method used. I would use questions to show you the difference between direct method and indirect method. Without wasting our time, let's solve past questions to practicalize everything we are doing. But let me open your mind to this. Note that the preparation of statement of cash flows involves extracting cash elements of the items in the statement of profit or loss and statement of financial position. All you're trying to do is to extract cash elements from all the items in this statement. You must extract all the cash elements. And this is the secret. So this is a secret methodology to extract cash elements from these items. When you have income in the statement of profit or loss, so you just need to ask yourself, if anyone is owing us, so you just need to ask yourself, do we have anyone owing us? I mean, your income, whether revenue or other income, is 100 naira. So you want to know, in that 100 naira, how much is cash? How much have I received? Simple. Just ask, is anyone owing me? If the answer is no, that means you have collected on the 100 naira. That means you have received everything. That means the cash element is 100. But if, let's say, you're able to identify that you had a receivables of 20 for that year, receivables of 20 for that year, that means 20 is owing you. That means out of that 100, you have only received 80. So when you identify this, subtract it from the income to derive the cash received from the income. And that's the cash element from that income. For expense, You just need to ask. If you owe anyone, you have in your P&L an expense of 100 naira. You want to know, have I paid all these 100 naira? Or how much have I paid in this 100 naira? Just ask, am I owing anyone? If you are not owing anyone, it means you have paid the entire 100 naira. But if you're able to identify that you are owing somebody 20 naira, that means you have not paid the 100 naira. You have only paid 80 naira. That's the cash flow. So when you identify this, subtract it from the expense to derive the cash paid on the expense. When you have assets and you want to know, I have assets. Did I buy assets this year? Because assets is not is unlike income and expense that is a yearly thing. Asset is a cumulative item. You carry it forward on a yearly basis. So what you need to identify in assets is to know whether you bought a new asset or whether you paid or whether you sold any assets this year. That's the issue. That's how to extract cash elements in asset. And how do you do that? So yeah, just compare the last year balance with the current year balance. The difference is the cash element. But you need to make adjustments for some non-cash movements that might have, there are some things that will have caused movements like depreciation, impairments, and revaluation. These are usually added or deducted from the asset. So the whole of that movement might not be entirely cash. So you will need to make adjustment for all of this. You need to make adjustment for all of this because there are some that might have been like depreciation and it will have been deducted before. So you have to add it back and all of that. For liabilities, the same thing, because all you want to know is that, did I borrow more money this year? Did I collect money from people? Or did I settle up? Again, just compare the last year balance with the current year balance. The difference is the cash element. And finally, is equity. This one too, just compare the last year balance with the current year balance. The difference is the cash element. You see, one of the easiest questions they can give you in the exam is cash flow. Like at both levels, both FR and SBR last diet, number one was cash flow. And simple. And that's of course if you know how to do it, which I'm going to teach you. Because it's a statement of changes in position. In fact, even if you're blank and you don't know what to do, just start with the movement first. Just go to your statement of financial position and be doing movements. And there are some ones that are peculiar, like assets. If there is depreciation for the year, you adjust for that and all of that. And you know where to put them. It's so easy because you will always be able to make a move. You always be able to make a move. Now, let's look at this question. Now, this question, it says financial statement of Shukuka Nigeria Limited are there below. They gave us P&L. They gave us 2-year statement of financial position. They have to always give you 2 years. Otherwise, maybe they don't want you to. It's not statement of cash flows they are asking. Then they gave us all that. They gave us some additional information. And we're asked to prepare statement of cash flows for Shukuka Limited. And they said, in the context of IS 7, explain cash and cash equivalent and give 2 examples. I think I already told you this today. And in accordance with IS 1 presentation of financial statements, assets and liabilities must not be offset, except when offset is required by another standard. Give exceptions to this rule regarding offsetting provided by IS 1. Okay. I haven't taught any of you guys IS 1. Now, let's look at the additional information. They said a financial asset included in the trade investment with a carrying amount of 1.5 was sold for 1,885 during the year with a replacement, while a replacement was acquired. Okay. There was an issue of 3,750,000,000 shares during the year at a premium of 32 kobo per share. 3, the short-term investment is highly marketable with 1 to 3 month maturity. During the year, the company paid dividend of 5.4 million to equity holders, and these had been accounted for during the year. Delivery vans with original cost of 6.6 and a carrying amount of 3.7 was sold for 2.5 during the year. The company is planning to take a long-term syndicated loan of 2 million, 2,000 million or 2 billion from a healthy Nigerian bank. The company financial statement and a loan application had already been submitted to the bank and is awaiting approval. Extract from PPE schedule review the following. A cash payment of 58 million in respect of insurance premium for the financial year was totally omitted. They are required to prepare this statement. Okay. Now, see, the best approach for you is always have an approach in the exam. Extract all the movement first while taking into consideration the information given to you. Don't miss out any of this information. Okay? Like I've scanned through this additional information now. I would note that, okay, there was a trade investment that we sold. And I would see that trade investment under non-current asset. Okay, I would make sure I consider it in my movement. Also, there was an issue of shares during the year. I consider it when I'm doing movement in share capital. Also, they said there is a short-term investment that is highly marketable with 1 or 3 months maturity profile. That means this short-term investment under current assets directly above cash in hand is also a cash equivalent. So I don't need to bother about the movement because I see it as cash. I'll use it as a reconciliation item because it's cash. It's cash in itself. So I don't need to extract cash element from that because in itself it's cash. Then they told me that I paid dividend to my shareholders. Okay, so that's noted. I was also told that I sold delivery van. Okay, I'll consider that in my movement of PPE. And the company is planning on taking a loan. I will totally ignore this because there is no cash element there. I'm planning to. It doesn't affect anything here. It doesn't affect anything here. Also, they gave me PPE schedule good. So this helped me to see the movements clearly. And yeah, they actually made a cash payment. They paid, but they omitted it from the books. So I just need to recognize it. So I need to recognize P&L and also the so that um I'll just remove it from my as an outflow in my when I'm doing my operating activities as insurance premium. And also I would also take it out for my cash balance. Otherwise, it's not balance if those two legs are not present. And that's all. So always start with your workings and have an approach. Pick up the movement. Just look at the movements. Like my PPE now, 29,235, 23,475. And good enough, the examiner gave us the breakdown of this 29,235 and 23,475. They gave me the breakdown because if they hadn't given me the breakdown, it might be a little difficult for me. Not difficult, I mean, but since they gave me the breakdown of this amount into cost and accumulated depreciation, then I will use that as my basis of my breakdown as well. I will break this PPE. I will do the movement for cost separately and movement for accumulated depreciation separately, since they gave me everything here in detail. So I'll start with the property, plant, and equipment. The level of rounding off is in millions, not thousands. So I'll start with the costs. I'll start with what's the opening balance of the costs given to me. They gave me 45,795, 45,795. Then they told me in note 5, they told me in note 5 that a delivery van with an original cost of 6.6 and a carrying amount of 3.7 was sold for 2.5. So that means there was a disposal of a delivery van. Now, because this is costs, what you would remove is the cost of the asset disposed, which is this 6.6. Which is this 6.6. If you mistakenly go and remove 2520, you are wrong, because there's a difference between the cost of the asset disposed and this 2520 is the amount or the money received from that disposal. This 2520 is the money received from the disposal. Actually, that's what we show in the statement of cash flows. That's what we show in the statement of cash flows. This 2520. But let's look at the movement and be able to identify whatever is balanced. Now, they didn't tell us that there was any addition, so I don't want to assume. They didn't tell me that they bought any plant during the year. So, is there any other movement that they tell me here? There is no movement. The only other one that a lot of students will omit is revaluation. is revaluation, because what causes movements in assets, in PP, is either addition, disposal, revaluation, impairment loss. So a lot of students will forget this and they will get it wrong. And if you look at it, last year our evaluation reserve was 9195. This year it is now 11280. That means there was a revaluation surplus in the current year. And how much is that?
2,085 naira.
2085. So there is a revaluation surplus, which is a non-cash item of 2085. And that's really everything around PPE, because is this note 5 that only told me about PPE that is sold? Fine. So with that in mind, I would expect my closing balance of my PPE to be how much? So can you cumulate these three items for me?
41,280.
41,280. But what was the actual closing balance of the cost? It was 55,395. Can you all see it under this note 7? The costs at 2005. So 55,395. So that means that increase, there is an increase in PPE, which will represent an acquisition. That's acquisition of PPE. Because for your PPE to increase, it means you bought additional asset. And this we are going to treat as a statement of cash flow item. And that's what we call movements. But you need to have a complete picture, especially for PPE. PPE is where you will have, you need to be very careful for some items that might not be apparent, but are there. Like disposal now, a lot of students might go and use the sales proceeds here. Whereas it's the cost, because we are looking at schedule of costs. So it's cost of the asset disposed we need here to match it with this cost. And that's how you operate. That's how IAS 16 works. What goes to the asset account is the cost. So you remove the cost. Also, a lot of students would not even remember that revaluation surplus is also there because there was movement in revaluation reserve. So there was a surplus for the year. They will fail to capture that movement. Then would have an expected balance. But when we compared it with what we have in the books, we saw that there was an increase in PP, and that is what we are looking for. That is where we want to be. That's the closing, that's the acquisition of PP. Additionally, I will do my movement of accumulated depreciation as well. This will help me identify if there is any depreciation for the year. So what's the opening balance of my depreciation? Is 22,320 from here. 22,320. Was there any, did they tell us about any depreciation for the year in the correction? There was nowhere it was mentioned. However, I know that I can determine depreciation on the asset disposed. Depreciation on the asset disposed, which is the difference between the cost of these assets and the carrying amount of these assets. What's the difference between that two?
two, 2,850, 2,850.
2,850. I said 6,600 minus 3,750. You said it's 2,850, right?
Correct, sir.
Okay. Now, what's my expected balance? What's my expected balance here?
19,470.
470.
But what was the closing balance in the books? $26,160. Abi? 26,160. So there's an increase, which of course would mean depreciation charged for the year. Now, how much is that?
6,690.
So this one, we'll use it as a non-cash item when we are making adjustments. Additionally, since I know that there was a disposal of assets, I would also note, I would also want to calculate profit or loss on disposal of delivery van, because they are non-cash items that I would need to adjust for, especially because the examiner wants me to use the indirect method. A lot of students will also miss out the method that you should. Some people just say, yeah, statement of cash flows, and they will start using their own method that they believe is easier for them. No, they always tell you that which method to use. And if they don't tell you, then fine, you move on. But if they do, make sure you use the method wanted. So let me get the profit or loss on disposal of these assets. What was the sales proceeds on this disposal?
6,000.
2,520. Sales proceeds was 2,520. And what was the carrying amount?
3,750.
3,750. So the difference, is this a profit on disposal or a loss on disposal?
A loss on disposal, sir.
Loss on disposal.
Okay. And what's the difference?
1,230.
Now I am fully done with movements in PP. So from my experience, I know that it's this movement in PP that is always the technical one, because you have to be very careful. You have to be very careful. So the easiest way for you is just work from the known to the unknown. Just keep it simple. Just be picking what they give you. Put it in the movement. Like me, I didn't establish what was not there. I just allowed the question to direct me to the answer. I picked the opening balance from the question. I picked the disposal from the question. I picked the revaluation from the question, but at least I have knowledge of that, okay, these are what causes movement. Then I looked for them in the question. Then I said, okay, this is what I'm expecting as balance. But when I looked into the balance given, I saw that is this, it has increased. That gave me my cash flow items that they bought asset. For depreciation also, I looked at the opening. I established the depreciation on the asset disposed, which I removed. Then I got my closing balance. I looked at the closing balance. I saw that it has increased. I know that that's the depreciation for the year. And I know that anytime there is a disposal of an asset, there will always be either a profit or loss on disposal, which I carefully computed as well. Now I can peacefully move on to the next line item, which is intangible asset. So let me look at the movement in intangible assets. So my intangible assets, again, similar approach. I'll look at the opening balance of my intangible asset. And the opening balance of my intangible asset is 16,300. 16,300. And from what I've read, I did not see anything. They did not give me anything around intangible assets. I can't see anything. If they had probably told me that, okay, they amortize the intangible asset to this amount, then I would have gone ahead to deduct that. But they did not mention that. So it's wrong to assume. It's dangerous. How many things do you want to assume? Because what about evaluation and other things? So don't assume. So since they didn't tell me anything, I will keep quiet. I'll just compare it immediately with my closing balance, which is 18,775. So closing balance, 18,775. I see that there is an increase in intangible assets. And this increase, just see, don't overthink, is an acquisition. For it to have increased, that means they bought intangible assets that year. So what's the difference?
2,475.
You put it in your statement of cash flows. Move on. The next item here is trade investments. This one, they told me some things around it in note 1 that they sold. Fine. That was all they told me. Then I'll consider that. So let me do movement in my trade investments. The opening is 2860. Trade investments. Opening balance 2860. They told me that there was a disposal. They told me that there was a disposal, and that's why I'm bringing in disposal as a deduction. Now, they said a disposal, a financial asset included in the trade investment with a carrying amount of 1.5 was sold for 1885 during the year. If I may ask you, which of these two am I going to deduct in that schedule? Is it the carrying amount or the sales proceeds?
The carrying amount.
Fantastic.
Carrying amount.
Fantastic. That's absolutely correct. Is the carrying amount. Yes, is sales proceeds that will go to cash flow, but for our movement's sake, is 1.5 million, which is the carrying amount, because this is our carrying amount too. So you cannot possibly bring sales proceeds here, but carrying amount. Now, and that was all they gave me. So I'm done. I'll just do, what's my expected closing balance?
1,360.
1,360. But what was actually the closing balance that we have? We have 1835. That is what we have. 1835. So there's an increase in trade investment. Again, when there's an increase in assets, do you know what it is?
Acquisition.
Acquisition. So how much is that?
475.
It goes to my what? Statement of cash flows under investing. So I'm done with this. See, you are picking points like that. You are quickly done with these non-current assets. You go to your inventories. You look at the movement in your inventories. You look at the movement in your inventories. What's the opening balance of my inventory? 7875. 7875. What's the closing balance of my inventory? 11,550. There is an increase in inventory, which is outflow acquisition. Just that inventory does not go to investing. We'll adjust it under operating. You will see how I'll do that. So what's the difference?
3,675.
3,675. Number 5 is my trade receivables. My trade receivables. What's the opening balance for this one? 25,335. Opening balance 25,335. What's the closing balance?
31440.
31440. Thank you. 31440. There is also an increase. There's also an outflow acquisition. How much is that?
6,105.
Can anyone, I mean, this one is clear that this is an outflow, right? The increase in inventory is like we bought more inventory. Who can tell me why increase in trade receivables is also an outflow, is an acquisition?
Because
Because
we
we
sold
sell
more. We sold more on credit, sir.
So how does that mean that we are giving money out?
We are giving goods out and our receivable increase.
Yeah, I can take that. I can take that. So even though it's not literally cash, but we see it as
It is
see
an
it as
outflow, sir.
it is an outflow. I agree
It
with
is an
you.
outflow. Yeah. The stuff we sold, I mean, it has a monetary value, sir. So it is an outflow, sir.
Okay, yeah. To a large extent, yes. Okay, so I'm done with trade receivables. They already told me that this short-term investment is a cash equivalent, so I don't need to look at the movement. And of course, cash in hand is a cash equivalent. Now, let me move to ordinary share capital. The opening balance is 11,250. So number 6, share capital. And the opening balance is 11,250. Okay, Michael, you can ask a question.
Okay, sir. Good morning, sir.
Good morning.
Sir, this gain or loss on investment, the one we disposed, we did not calculate it. Just like
And
we did to
Thank you very much, Michael. Thank you very much.
Yes.
Fantastic. So let's do the profit or loss on disposal of trade investments. So what was the source proceeds for that trade investment? It was 1885. The source proceeds is 1885. And what was the carrying amount? Is 1500. And this is a gain on disposal of trade investments. Of how much? Of 385. Yeah, thanks. So it is also a non-cash item that we need to adjust. We need to remember to adjust it. So back to share capital. Did it tell us anything around share capital? Yes, in note 2. We're told that we issue some shares, 3750, and we issued it at a premium of 32 kobo. Knowing fully well that if you see the term here, the ordinary share capital, it shows that the nominal value of this share capital is 1 naira. So they issued it at a premium of 32 kobo. But I know that what goes to my issue of shares, what goes to my share capital is nominal value of 1 naira. So this is 3750. This goes to statement of cash flows under financing. So what's the expected closing? Who can add this together?
Hmm.
15,000.
15,000. And what's the closing balance itself?
15,000.
Okay, good. That one is expected because there's really nothing else again that will have cost movements, except if there's a bonus issue, which will not have any cash impact. So the next one is my share premium. And what's the opening balance of my share premium? What's the opening balance of my share premium? 9,300. 9,300. There was issue of shares of 3,750, which we issued at 32 kobo. So how much is that?
1,200.
1,200. So what's my expected closing balance?
Times 5.
500.
But what's the closing balance in the books?
10,500.
10,500.
Good. So that one is done and dusted. I know that this is what goes to my statement of cash flows. Then after that is revaluation reserve. I already picked the movements here. Which I added to my assets, if you remember. This one. So I don't need to bother myself around that again. Now, retained earnings. So let's get the movement in retained earnings. So which is 13,860. 13,860 opening. 13,860. What will cause movement here? I will have my profit for the year. And what's the profit for the year? 9,465. Profit for the year is 9,465. 9,465. Then they told me something around dividend. Dividend is paid from retained earnings. I hope you know that, not from profit for the year. It's paid from retained earnings. So in note 4, they said there was a dividend paid of 5,400. So dividends paid. Because this will go to statement of cash flows under financing, and that's it. So what's my expected closing balance?
17,000.
17,925.
17,925. But what was the closing balance that we have?
17,925.
Okay, fantastic. 17,925. So that is also done and dusted. What again? Then we move to non-current liabilities. Look at the movement in the non-current liabilities. So let's look at that. There was a 10% loan note. There was a 10% loan note.
So you wrote the closing balance as 19,925.
Oh, okay. Thank you very much. So what was the opening balance of this loan? 6,500. 6,500. They didn't tell us anything around this. So what was the closing balance of this loan? 12,780. 12,780. So there's an increase in loan notes. So these additional borrowings. So what's the difference?
6,250.
6,280.
6,250.
280.
So this goes to the statement of cash flows. This goes to the statement of cash flows. Then the next one is deferred tax. So usually we don't treat deferred tax in isolation. We are going to treat deferred tax and current tax. We'll treat them together as one. So we'll combine them together. Okay, so let me just, number 10. That's my taxation all together. So I'll have my opening. I'll have the deferred tax and also the deferred tax and current tax. What was the opening of the deferred tax? That's 3,750. 3,750. What was the opening of the current tax? That's 846. 3,750. And this is 8,460. This is 8,460. Then the income tax expense for the year, again, we'll also have current tax and deferred tax for that as well. So which you are going to find in P&L. So in P&L, the addition of the two, so I don't need to separate it. They already added it. Income tax expense, deferred tax. The addition, they gave me 8850. So let me just have my income tax expense, 850. So what's my expected closing? What's my expected closing balance?
21,060 naira. 21,000
1,000.
is 060.
Okay, 060. But let's get what the closing balance is by adding the deferred tax closing with the current tax closing. So what's the deferred tax closing?
15.
15. What's the current tax closing?
9,240.
9,240. What's the addition of the two?
9,390.
No.
10,740.
Michael, how come I be expected closing, then closing? So there's a decrease. There's a decrease in tax, in income tax, in taxation. Of how much?
10,320.
10,310. This decrease, what does it mean?
Tax paid.
Tax
Fantastic.
paid.
Fantastic. Because for our tax liability to decrease, it means you have paid taxes. But anyway, for liability to decrease generally, it means you have actually paid off. What again? Yeah. We have trade and other payables. Opening is 9150. That's note 11. Trade and other payables. Opening balance 9150. And what's the closing balance?
12,810.
12,810. So this one is an increase. How much?
3,660.
3660.
So this is like inflow, because like we are taking something from our suppliers. You know that you are done. What is left is just easy peasy for you. Just do this movement and go and rest. Cash flow is that easy. And by implication, we have touched all of these adjustments, except maybe this 58 million that we'll touch in the actual statement. This cash payment that they said they made. It is that easy. It is really that easy. So let's prepare the statements straight up. So what's the name of this company? Shuko Nigeria Limited. Statement of cash flows.
You're asked to use indirect method. For the year ended when? April 30th, 2025. In activities. Now, when you're using indirect method, all you're doing is just you start from your profits. You start from your profits. So usually, in fact, yeah, I have no choice. I have to start from my profit before tax. So let me start from PBT. You can start from profit from operations, anyhow you wish. But my profit before tax is 18,315. Profit before tax is 18,315. And all I want to do, the whole idea behind indirect is take this profit. Take this profit and convert it to cash. Okay? Take this profit and convert it to cash. Now that is all we want to do. Okay. Omomi said, can we have the template for format for each of them? Yeah, I will solve questions on each of them. So it's not like I'm going to give you formats. That is not a good way to learn cash flows. You need to just do movements and solve questions on the two methods. Don't cram formats for statement of cash flows. Never ends well that way. That's why it looks as if it's difficult when it's not. So I won't give you formats, but I'll solve questions on the two methods for you. And they are the same, it's movements. So the differences lies in the operating activities. So this is indirect method now. You understand it, you can solve any question on indirect method. So let's extract all the non-cash items from here. But before then is this, this finance cost is always something you need to have a way of dealing with, right? So finance costs, you can either decide to treat it in operating or treat it in financing, either one. So you can either treat it in operating or treat it in financing. Don't worry, Michael, I'll share it. Let me just keep scrolling like this. It's not difficult. So this finance cost is 5,220. So I like to treat it in financing. My own method is I want to treat it in financing. So what I would do is, since they have deducted it from profits, they have deducted it in deriving this profit. So I want to take it away from profits. I want to take it out and go and put it in financing. So I'll go and remove it under financing. Okay, so this 18,315 they have already adjusted for finance costs as an outflow. Of course, it is an outflow. And from this correction, this 520, 220 is purely an outflow. It's purely cash outflow because I am not owing anybody. And I know that because when I go and check my liabilities, I can't see any interest payable. Usually I will find it in current liabilities. That shows that this finance cost has been paid fully, right? So I can decide to leave it, no, but don't leave it. We want to see it as a separate line item. So what we do for this finance cost is an outflow. They have deducted it from year before. I don't want it here. What I will do is I will add it back. I will add it back to the profits. So I've net the effect of. So if I cumulate these two now, it has taken me back to profit from operations or profit before interest and tax. It has taken me back up. That is why in some cases, I like to start from profit from operations. So I will then treat my finance cost where I want to directly without having to make this adjustment first. Because this confuses some people at times. Why are you adding it back and all of that? Because when I add it here, I will still go and remove it. So it's always confusing. And typically what I'm doing is that I'm saying that this item, I don't want to treat it in operating, right? And considering the fact that it has already been deducted here as an outflow, let me add it back. So I know that it is not in this profit again. Okay. And at that point, I will then go and treat it in my financing. Some people still treat it in operating and they will put it back in operating as an outflow. It's a little confusing. So I put it in financing where it belongs. So after I've clarified the finance costs issue, then I can then make adjustments for non-cash items. I can make adjustment for non-cash items. So before I proceed with that, I think I have questions up here. Shineye, go ahead, please.
So, sir, please, does it mean that whenever we are being given a question, if the question carries profit before interest and tax, we should just speak that directly?
Exactly. Just speak that directly. So that
Thank
you
you,
would
sir.
avoid this adjustment and all that. And the benefit of picking that directly is that you then decide how you want to treat your finance costs, whether you want to treat it in operating or financing. Me, just go and treat it in always have it in mind to treat it in financing. It makes everything clear. Now, let's adjust for non-cash items. So remember, indirect method is just converting. You want to convert this profit to a cash profit. So and all the non-cash items hiding under admin, interest, gross profit, cost of sales, revenue, we want to extract all of them. Okay. And the ones that will be hiding under admin, let's add them back. Number one would be depreciation, charge for the year that will have been deducted. So we need to add it back. Depreciation charged on PP 6690. The second one, after depreciation, is loss on disposal of delivery van 1230. That has been deducted. Let's add it back. Loss on disposal of delivery van. After that, the next one is profit or loss or gain on disposal of trade investments of 385.
No, there's this I'm the hand sanitizer. No one there. Look at it, that's what there is.
I've muted him. I don't know why he's unmuting himself. Then, after that, after this gain on disposal, then that's really all for non-cash items here. So can you sum all of this together for me? So this will be deducted because it will have been added before. So now we deduct it.
8,000.
7535. 7535.
7535.
Yes.
It's 7920.
Are you sure?
Michael is correct, sir. You asked us
Okay,
to deduct.
7535.
Okay. We are going to add it back because we added depreciation back, added loss back, then we are deducting this one. And understand why we are doing that, because depreciation is an expense. It will have been deducted before from this profit. So adjust for it, we add it back. The same thing as loss, we add it back. But gain that was added before, we deducted it. So to get this. So a net addition. And also, this one, the format choose to call it adjustment for changes in working capital. But I mean, it's always this one. I mean, I wonder why they choose to call it this, because all you are doing is just making adjustment for non-cash items. Also, that's all they're doing, and which we have already done the workings, and usually this is what they're doing. We have removed all the non-cash items here in this admin, but in this cost of sales and revenue, there are some non-cash items there. Like the cost of sales, there are two. One is trade payables, increase in trade payables for the year or decrease for the year. Number two is inventory for the year. That's non-cash item. Revenue, your receivables for the year is a non-cash item. So I don't know who sat down and said, okay, let's call it adjustment for changes in working capital. I mean, it's a little confused. Some people will just be cramming formats. They won't understand that all we are doing is just adjusting for non-cash items. Okay. So I mean, if not that the format has actually stated it, I will just put everything under adjustment for non-cash item, because IFRS is not really about format anyways, though they encourage you that, okay, follow the minimum requirements in our format, but it's not compulsory. Okay. But I mean, I need you to understand it that way. So let's pick up increase in inventory first. We did the workings already. Okay, yeah. This outflow 3675. 3675. Additionally, we have increase in receivables 6105, also an outflow. Increase in receivables 6105. And thirdly is payables. Where is it? Yeah. Increase in payables. This will be an inflow. Increase in trade payables. So can you adjust this three for me?
6120.
6120. Outflow, Abby.
Yes,
So
sir. Outflow. Yes.
okay. Now, so you need to understand these things, right? So what I've done so far, remember that I'm working back from profits before tax. Okay, if I was given profit before interest and tax, I would have loved to work back from there. So I will not have been adding back this one, but I mean, I was not given, so I can start from here, then add this back. I've adjusted for all the non-cash items here. The loss on assets, depreciation, profit on disposal, and all of that. I've adjusted for non-cash items in cost of sales. I've adjusted for non-cash items in revenue. Now, there's one more item I've not touched, which is this interest received. I have to touch it. If I just keep quiet around it and I don't say anything, I'll still be correct to a large extent because it's purely an inflow, this interest received. But interest received, I should not leave it in operating. And don't just keep quiet around it. You need to bring it out from operating and go and put it in investing. So since they have added it before to operating, let me bring it out from it by adding it back. So interest received 1670. So they added it before. Now I will remove it. So with this now, I've converted. If I accumulate all this, that will give me the cash element of this profit before tax. But I won't stop there. To finalize all the items in P&L, then I'll go back to my tax, income tax. Thankfully, I already did the workings for that in note 10. I already got my tax paid as 10,320. So I will have my income tax paid as 10,320. Then I'll go ahead with whatever I'm doing. Now I can stop here, but the examiner told me that there was a payment they made that they did not even put in the books at all. They made a payment for insurance premium of 58, which is an expense. They should have put it in our admin expense and also remove it from our bank. They did not do any of the two. They said it was totally omitted from the book. It was totally omitted. So I need to put it as an outflow. Insurance premium, 58 million. So now I've treated it in my books. So when you cumulate all this together, I will get net cash outflow or inflow from operating activities. So can you cumulate all this together? 18,315 plus this minus these other ones.
12,902.
12,902. Then I go to my investing activities. And I told you that the items in investing activities are obtained from the asset portion of the statement of financial position. And thankfully, I have done my analysis of these three items. I've done my analysis of all of them. So I just need to go and be picking the movement. So I go to the movement. First, I look at this increase in PP or acquisition of PP of 14,115. I put it there, 14,115. Secondly, I look at my disposal. What I need there is the sales proceeds of delivery van of 2,520. This will be an outflow. Sales proceeds of delivery van is an inflow 2,520. So I've picked all the cash elements here. I've picked the assets we bought. I have picked the assets we sold. And I carefully ensured I'm picking sales proceeds for assets we sold. I did not go and pick carrying amount or cost of the assets disposed. That would be wrong. That's not the cash element. The cash element is the money received. Why for the asset bought is the cost of the assets. That is the money you paid for that. Then I moved to my intangible assets. There was an acquisition of intangible assets of 2435 to also be treated as an outflow. So acquisition of intangible assets, outflow 2435. And also, after intangible assets, there was an acquisition of trade investments, acquisition of trade investments of 475, acquisition of trade investments of 475, outflow, acquisition of trade investment outflow. Also, there was a disposal of trade investments of 1885. Trace proceeds of trade investments is an inflow of 1885. And that is it for those non-current assets items. And lest I forget, this interest received that I deducted because it was in operating, I come and put it where it belongs as an inflow in investing. Belongs here. So let me cumulate all these items together. That will give me my net cash. This one, they didn't even tell me whether it's an inflow or outflow. Anyway, if it doesn't balance or not. So net cash inflows or outflow from investing activities. So how much is this?
10,990 outflow.
10,990 outflow. I guess this one is an inflow, Abby.
It is an inflow, sir.
Okay. And finally, is financing activities. And for my financing activities, I just need to focus on movements in my share capital and liabilities items. And thankfully, that has been done already. So I start with movement in share capital. There was issue of shares of 3,750. Share capital 3,750. And there is share premium. How much is the share premium? 1,200. 1,200. There is dividend paid under retained earnings. Outflow of 5,400. And there is, after dividend paid, there is loan notes There is loan note of 6280. As an inflow because we collected loan. And I can't see any other one here. Is there any one that we have not in financing? Let me see if any of you can remember.
The finance cost.
Thank you, Semiat. Finance costs. Outflow of 5220. Outflow of 5220. So can we cumulate this together?
$610 inflow.
$617.
No, 610.
610. Okay, so this is how cash flow is done. This will have earned you. This is the easiest way for you to make it easy for you. I can't really think of any other way to, even in practice, in real life, just do your movements. When you see a statement of cash flows, be happy. Just be doing the movements while taking note of those additional information that would fit into any of the movements. You see, all I did was just movements. That was all I did. I did not rush one by one. And I know that as soon as I've done that, I'm done with the work. And anytime they tell you there is a disposal, they know that you have to do profit or loss on disposal because it will constitute a non-cash item at the end of the day. And you find it easy. You find it easy if you practice more correction. So there's now a portion that you would then use to do a reconciliation of cash and cash equivalents. That I told you that you do your opening cash and cash equivalents, which will comprise of, in this case, our short-term investments, to comprise our cash in hand and bank overdrafts. These ones are the cash at the beginning. And in our statements, short-term investments at the beginning is 2790, cash in hand is 360. So 2790 and 360. 2790 and 360. Bank overdraft will be in jackets because it is a liability, it's an outflow. And what's the bank overdraft? 7530 here. 7530. So what are we looking at? How much is that?
380. Negative
Huh?
4380. Outflow 4380, sir. Outflow.
Okay. Then you would do your cash and cash equivalent during the year. Which is addition of your operating
investing, and financing. What's your operating? 12902. Inflow. Where's your investing? 10990. Outflow.
610.
What's your financing? 610. 610 inflow. So what do you have?
2522 inflow.
Sorry?
2522 inflow.
Inflow. Then, what's your cash and cash equivalent at the end? So let's cumulate these two. What do we have?
1858 outflow. 1858.
And to confirm that, you compare this with the cash and cash equivalents in the SOFP, which comprises the short-term investments, the cash in hand, and the bank overdrafts. And what's the short-term investments? $3,810, cash in hand 930. 3810930. 3810930. And what was the bank overdraft? $6,540. 6,540. So when you accumulate it, how much does it give us?
Outflow 18.
1,800, right? Okay, so why is the 58 coming up? Can anyone remember?
The error that they made.
The transaction that was omitted.
Okay, so the omitted insurance premium payments that they made, which is how much?
58.
So if you reconfirm, will you now give us 1,858?
Correct, sir. 1858.
Okay. So that's how you work on statement of cash flows. It's not difficult. Not difficult at all. So do you have any questions?
Yes, sir. Good morning, sir.
Good morning.
Good morning, everyone. I have a question regarding that insurance premium. I wanted to have why was it not added to the opening of the cash and cash equivalent?
It cannot be added now. It's a transaction during the year.
No. Okay.
So it has nothing to do with the opening. It just happened during the year. So which was why we expensed it as an outflow year. And we went
Okay.
to remove it from the closing balance. So that's the two legs
Okay.
of the
Okay, sir.
cash here.
Yes.
Should we solve one more question on direct method or we continue from next week?
I know, sir.
Yeah,
So
Mr.
let's solve
Kutomi.
on direct. Thank you.
Yes, in front of your adjustment, you were making working from the same end. Is it necessary for that?
Oh, I'm struggling to hear you, Mr. Christopher. Or did anyone hear him? I could not hear him.
No,
Maybe.
he's far away from his mic.
Oh, okay. No problem. So,
Well, you can hear me now?
yeah, it's better now.
Okay, I said the cost of your working, so you were making adjustment for return earning. I don't know whether is it necessary for computations of cash flow?
Yeah, very necessary. So if you had actually started with us from the beginning, make sure you do all movements. If you don't do it, you miss out on a lot of details. Like in this routine earnings, now that was where we were able to discover. So this question was easier because they actually told you about paid. In some questions, they will not tell you. It is these movements that will show it. So it's necessary. Make sure you do it. Okay, let's solve this other one on direct. Then when we come next week, we're going to solve the question on consolidated. So skills, those doing FR as well, you also need to know consolidated because this is a past question. So we're going to solve 2 questions on consolidated next week to finish up cash flows. But let's solve this direct method now.
Sir, hello,
So,
sir.
yeah, Michael.
Yes, sir. I want to ask, I want to be sure, sir. Is it necessary we start indirect method that operating expenses from profit before tax? We can't start from gross profit.
Don't start from gross profit. Why would you want to start from gross profit? So it's either you start from PBT or profit from operations, because the aim of indirect method is to convert that profit from operations to cash profits.
And because,
So,
sir, a reason why I ask is that I know that, I did it in skills, and we don't start from profit before tax. This is why I asked the question, sir. I know that we use another profit, but which is not profit before tax, sir. But it might be profit from operations, like you said. It might be, sir.
okay, all right. All right, but don't start from gross profits, please.
Okay,
Biko.
sir. All right, sir.
Okay, now let's look at direct method. This is also a past question. So they gave us the statement of profit or loss and other comprehensive income for the year ended of this company. And they gave us statement of financial position for the 2 years. So these ones have already done the increase or decreases for us. So they have already done all the movement for you. So these guys are really nice. So I don't really even bother about all the movements anymore because I already have it in the question. If they don't give me in the question, which is why, like I was telling Mr. Christopher the other time, you cannot say you are preparing statement of cash flows and you're not doing all the movements. That one is necessary, one is not. And unfortunately, he has even left. He's not here again. But I hope he listens to the video later and hear me. So now the additional information given to us, they said plants which had a carrying amount of 40 million was sold for 56 million cash, and new equipment was purchased for 200 million. Intangibles valued at 60 million were acquired for cash. Borrowings of 40 million were made during the year and received in cash. Dividend paid amounted to this, prepare cash flow. So now, when you are doing direct method, so I can move directly to my statements and start working out the cash movements directly, or start identifying the all the cash items, since they have given me the increase and decrease in my investments and assets and liabilities and all that. So I can really move on to preparing my statements immediately. So the only thing here is this, which is not even necessary. So let's look at Ogbagi PLC. I'm preparing my statement of cash flows using direct method for the year ended 31st December 2022. Operating activities. And when the level of rounding up is in thousands. Now, for direct method, this one requires you to pick out the cash element of each items one by one. I told you that the difference between direct and indirect lies in the treatment of operating activities. Investing and financing are the same, irrespective of the method you're using. And as you can see, when we use the indirect method for the first question, we saw that all we are doing is adjusting non-cash items from our profits before tax or profit from operations. We're adjusting for non-cash items. That's all we do for indirect, so that we can convert that profit to a cash profit. But direct, that one you start from the beginning and start extracting the cash element of it. It's more tedious, but it's better. It's detailed. Everything is clear. Like, for example, your revenue. They gave us revenue of 3.2 billion. So how much of this revenue is cash? You just need to ask yourself, do we have any receivables for the year? Yes, we had receivables for the year of 36 million. There is account receivables here of 36 million. So there is receivables for the year. So that means we did not receive the whole of that money. That means our cash received from our customers is that 3.2 million minus that 36 million. Minus that 36 million. That gives me the cash I received from my receivables, from my customers. So how much is that? Nobody?
Sir, 3,164,000. 3,164,000.
Okay. The next item is interest income. But interest income, I'll just make sure I remember to treat it in investing. I'll treat interest income in investing. So I won't touch it here. I'll treat it in investing. Additionally, I have gain on sales of plants. Gain on sales of plants. This one is a non-cash item. So I will ignore it because it is non-cash. I move to expenses. The first item here is cost of sales. and my cost of sales is 1,920. And in my cost of sales, what I need to extract is the cash paid to suppliers. And since my total cost of sales is 1,920, 1,920,000, I need to ask myself, is there inventory for the year? Yes, there is inventory of 20,000. I need to also ask myself, am I owing anyone for this year? Yes, I am. There's account payables also of 12,000. So my inventory 20,000, my account payables 12,000. What's the balance that we have?
1,888,000.
Now, this will come in as an outflow. Let's be careful here. Another way is this, From this cost of sales, I just want to check something. I can have, what's my opening inventory? My opening inventory is 260. Then my purchases. Then I deduct my closing inventory, which is 280. Then I have my cost of sales, which is 1,920. So this one should then be 1,940. This should be 1,940 as the balancing figure. Then I can then know my opening payables. What's my opening payables? 168. Purchases. And was the expected closing? If you add these two
2
together,
million. Yeah, 2,108,000.
but what was the closing? $180. So that means I've paid how much?
Yeah, for 4,928,000.
Payment to suppliers.
Yeah, 4,928,000.
Yeah, that's why I want to be very careful. So this increase in inventory will be added. to my cost of sales. So it's like I bought additional inventories. Then before I deduct the people that I'm owing. So what would this give me?
1928. 1928.
Yeah. This is a longer process anyway, but is a longer process. When I can easily do this, since the examiner gave me the movement already. If they didn't give me the movements, then fine. This is a longer process. But I can use this approach that my cost of sales is this, okay? So I want to extract the cash movements there. First, I bought additional inventory of 20 because my inventory increased 20 and I'm owing 12. So I deduct 12 for the year. And that means this is what I've paid. This is what I've paid for the year. So choose the one that you like between this one and this long one. Either one is fine. So I'm done with my cost of sales. The next item is staff remunerations, which is salaries and wages, and it is 480,000. Now, I want to extract the cash element of this. Then it's an expense. I need to know, am I owing anybody? Am I owing anyone? Salaries? Yes, I
Yes.
am. So there is a staff remuneration payable of how much for the year? 4,000. So I'm owing 4,000 for the year. And my expense is 480,000. So staff remuneration is 480 minus 4,000. How much is that?
For
For
76,000.
1,000.
as an outflow. The next item here is depreciation. And depreciation is a non-cash item. So I will omit it. I will leave it. It's non-cash. Then the next item is interest expense. I would also leave it in here because I want to go and treat it under financing. So I would ensure it is well treated under financing. Then the next item here is other expenses. So I'll ask myself, am I owing anyone? Am I owing anybody other expense? Yes, I am. There is another expense payable of 4,200. But in this case, I'm not owing additional, but it's even a negative amount because it decreased. So I will have my other expenses. How much is it in the P&L? 304,000. It did not, I'm not owing, so I can't say I want to deduct, but I even paid more. I paid more this year. So my obligation decreased by 4.8. So 4,800. How much does that give us?
308,800.
308,800. Then after my other expenses, The next item here is income tax expense, which is 120,000. Am I owing income tax expense for the year? Yes, I am. I'm owing 8,000. So the income tax expense here is 120,000. So tax paid, we have 120,000. Not only that, there is an income tax also. There is an income tax also in OCI of 24. There is one of 24. And how much am I owing for the year? So out of this, the current tax is 8,000 for the year. And the deferred tax is 14,400 for the year. These are the ones I've not paid. So how much have I paid?
$100,000.
100,000 as my tax paid. If you are not following this, it's the same thing as what we have done up here, but you will see that this one took us a long time to finish up. It's just doing this opening and closing. But the examiner already did the changes for us. That's why I'm just showing my workings on the face. So I wouldn't have to do changes. I just need to understand what's happening. And it's quite logical because they told me that my sales is 3.2 and they are owing me 36. It means I've received the difference. I paid my suppliers, or my cost of sales was this. They showed me that I bought inventory of 20 additionally, and I'm owing 12. My staff salaries is 480. I'm owing 4. That means I've paid the difference. My other expense is 304, and I even paid additional 48. I'm not owing at all this year. I've paid much more. So that means I've paid the total of this. My tax for the year is this too. For the year, I'm owing this and this. So these are the ones I've not paid. Then that means I've paid the total tax of these amounts. And that is all for my operating. But before I say that is all for my operating, there is still one item I've not touched here, which is gain on sales of investment, which is a non-cash item, which I will ignore. Okay, Michael, I can see your hands.
Yes, sir. Sir, please, I want to understand. Staff remuneration is 40,000 and we are owing 4,000, which we have not paid. It means
Yeah.
it will increase, sir, because we are supposed to pay 40,000 now, and we have an outstanding of 4,000. So we have to add it to the 480,000, sir.
No, you're interpreting it from the standpoint of that you don't understand it very well. What is in the P&L is the expense for the year. That's what happened for the year. What is in the financial position is the balance. What's financial position is
is like a balance, the position as that date. So if they tell you that our staff remuneration in P&L is 480, that means our expense, our staff salaries, total staff salaries is 480, it's no more than 480. So out of that 480, they said for this year, we are owing 4,000. We are only owing 4,000, which means that you have paid 476 out of that 480. So if you now see 484, it means because all these things you are seeing here is the actual payment and receipts. That's statement of cash flows.
I understand now, sir. I understand. The actual money that went out is 476. The actual cash.
Yeah. Yes, if you understand that, that applies to everything I'm doing here. That applies to everything I'm doing here. So just find a way to understand it very well, and you're getting the same answer. Then stick to that. Okay, so how much is here?
352,000, sir.
652.
352,000, sir.
Outflow or inflow?
It's an inflow.
Okay, thank you. So the next one is financing.
Sir, I got 351 200. 800 is
Correct.
there now. 308 800. So you can't have 800 and still get a round figure. That is 200.
Thank you very much, Michael. So we have corrected it. No, before financing, let's do investing. So let's do our investing activities. So we are done with all this. Just so that I won't forget, there are some items. Where are they now? Okay. This one I'm working on. Yeah. So there are some items like this interest expense. Okay, that one will go to financing. I think there was interest income. Let me go and put it there first and get the cash element of that first. So we paid, not that we paid, the income earned is 20. Let's confirm whether we received the whole of this 20. So we go to, is there anybody owing us? So yes. They are not even owing us. So it's even negative. Nobody is owing us. Nobody is owing us. It's negative. So that means it will be 20,000 plus 200.
Manage data mi.
SME àtàtì gbọ́ pé manage data. Then you can mute now. 20,000 plus 200. That's 20,200. So that's for the interest income, just so that I won't forget. So I've sorted that out. Now, let me go to my statement of financial position. The items that will affect my investing. First, this is my plant and equipment, investments, intangible assets. All of that will definitely affect my investing. So my plant and equipment first, it's increased by 60,000. So that's an acquisition for the year. So, but for me to confirm that, they said that there is a plant which had a carrying amount of 40, but was sold for 56,000
and new equipment was purchased for 20,000. So how does that explains this increase of 60? So I think the best way for us is to do a kind of reconciliation. For these plants, because the opening balance here for this plant was 600. Which is carrying amount. And there was a disposal of 40. There was a disposal of 40. I picked the carrying amount. They say it was sold for 56. I know that it's this 56 that will go to cash flow, but I mean, this is the carrying amount that will come into movement. And a new equipment was acquired for 200. So addition, 200. Then I was given depreciation on plant and equipment of 100. Depreciation of plant and equipment of 100. So what's my expected closing? How much will this give me?
660.
Sorry?
660,000.
So what closing do I have? Okay, 660. Okay, I just needed to, so it has balanced out now. I just really need to see, I needed to understand this 60 that is moving here. There is no other thing aside what they have told me. Okay, fine. So I can go ahead and under my investing, I can put sales proceeds on plants as an inflow of how much? 56 million. And also acquisition of plants of 200 million. Acquisition of plant of 200 million. So that's really sorted this for that plant. Next one is these investments. So investments increased by 8. So that means they invested 8 million. Did they say anything around that investment? No. They didn't say anything around that investment. So I will just put it there as acquisition of investments of this 8 million here. This 8 million here, acquisition of investment. Then the next one also is this intangible assets. It increased by 60. Hold on. Is this acquisition of investments? I think this investment that we did, where is it? It's increased now by 8,000. So how come I'm having a gain on sale of investment here of 8,000? Does that mean they have sold that investment? For how much? And they didn't say anything around that. and it increased. Let's continue. So this one, the 60,000 increase, intangible was value were acquired for cash. So this one, we'll cancel it out. Tangible assets. So acquisition of intangible assets. 60. So this acquisition of investment, let me just take it out because I don't know.
Sir, I think, sir, can you hear me, sir?
Yeah.
Yes, sir. I think it should be left. At the end of the day, we understand if we need to remove it or we need to leave it, sir. I think we should continue, sir.
Yes, I actually get your points. So, I mean, it's a mistake from the examiner. I know that clearly, but I know that it's not going to be there because I know that this gain on sale is not actually gain on sale. It's actually gain on, for you to be in OCI, it's not gain on sale. What the examiner wants to put there is actually fair value gain on investment. Okay, so that means this increase in investments is not as a result of acquisition, it's not as a result of cash investment, but because of fair value gain. So I know that for sure. So I'm just, I'm solving this as a student that, okay, if I'm a student, I'm just being confused as a student that is brilliant, that, why are they putting gain on sale in OCI? And here is, so apparently the examiner is not wanting to put gain on sale because they did not sell any investment. It's actually gain on revaluation or fair valuation of that investment. So let's remove it. So after that, then we are done with all of this. Ordinarily, we are done with investing. But there is one asset I've not touched, and I really have to touch all assets. I don't have to touch cash because cash is just cash. So I've touched receivables, I've touched inventories, I've not touched these prepayments. I need to take note of the movement. I've touched this receivable plans, investment. So what do we do with these prepayments? Prepayment, they paid something in advance, so it's a cash payment. So since it's current, I will just, it will have been a perfect candidate for operating. But let's just increase in prepayments. Outflow of how much? Outflow of 6,000. 6,000. Okay, let's cumulate it together. What does this give us?
189,800 outflow. 800.
Thank you. Then I have my financing activities. Before I forget, let me quickly put my interest paid. This is my interest expense of 16,000. Did I pay everything? No, I didn't pay everything because there's an accrued interest for the year of 800. So I'm owing 800. So the expense is 16,000. Out of this 16,000, I'm owing 800. So 16,000 minus 800. That's an outflow of 15,200. So I've paid only 15,200. So I've dealt with that interest expense. Now, other items that I've not touched in my liability parts, I've dealt with account payables, staff remuneration payables, accrued interest, other current. I've dealt with this. So these long-term borrowings, so I borrowed 40, which they also told me in note 3. They told me in note 3 that there was a long-term borrowing that I received during the year. So I will have my long-term borrowings of 40 million. I received it. Then after long-term borrowings, share capital did not move. Share capital did not move during the year. But my retained earnings moved during the year by 96,000. But there's a dividend paid. I know that is the dividend paid will be the major cash movement there. So I don't have to do the movement here. Let me not bother doing that. 200 million as an outflow. Then I have fair value reserve. So my fair value reserve increased from 0 to 5,600. And I guess the increase in the reserve was this 5,600 here in this other comprehensive income as a result of fair valuation. So we're right after all. This gain on sale is not gain on sale, but a fair valuation. And that's why we are having an increase in reserve of 5,600. So let's cumulate this together.
$175,200. Outflow of 175,200.
175,200. So let me do my reconciliation of cash and cash equivalents. So opening cash and cash equivalents. How much is it? Opening of 240. So cash and cash equivalent during the year. So the financing, the operating was 351,200. The investing is 189,800. And the financing is how much? 175,200. So what do you have as balance?
13,800 outflow.
Sorry?
13,800 outflow.
Okay, outflow of 13,800. Then my cash and cash equivalents at the year end, when you subtract the two, what does it give us?
226,200.
Which should be the same thing as this. This one we have in this statement of for the year. So everything jived for us. So at least I was just being careful in my methodology for direct. So direct needs careful analysis. You pick the items one by one, and you shake it for their tax and for their cash movement. And these workings that I did is not necessary because this one can fly. This simple one can fly. So just take your time to review all of this and solve as many questions as possible. So revise this one first, understand it. If you have any challenge, let me know. And solve as many other questions as you can. Then when we come next week Sunday, we're going to solve this question. We'll solve this question 3. We're going to solve 2 questions on consolidated equivalent of cash flows. Then we'll be done with statement of cash flows. So I'm not sure you guys have any lectures again today. I'll advise you have a lot to catch up with because we have done so much, both in my course and in other courses. Go and use the time you have to study. I'm not going to have any class with you guys again today. So go and take your time, read very well, practice. Go and practice this cash flow. Take this one out of it because you'll find it in your exams. These are and it's simple if you follow it methodically. So we are still going to solve 2 more questions on consolidated, and that we're going to use to end with the major part of your syllabus. That the only thing in your syllabus will be ratio and EPS that are major that we have not done. Ratio and EPS, and which we are definitely going to do. So most likely, I'm looking at next weekend. We'll start. Then we shall end that this coming week, both ratio and EPS. So I'll see you guys later then. Bye bye.
All right, bye bye, sir.
Yeah.